Hey guys, welcome to the ValueHunt podcast. And today I'm so excited to be here with Leandro from Best Anchor Stocks. It's one of the best Substacks I've found out there, and yeah, it's really amazing to have him here. And I bet we'll learn a ton. So please stay focused and take notes because this will be a very exciting conversation. So yeah, Leandro, why don't you say a couple of words before we jump right into the first question?
Well, thank you for having me. It's great to be here, and it's honestly great to see people so young as you being so interesting about the world of investing. Right, I think that's very necessary in the world we live in today. So thanks for having me.
Oh, great! Yeah, I guess we are both trying to do the same, which is like kind of share the beautiful art of investing and what we learn along the way. So, yeah, that's really interesting. So, the first question I have for you is, who is actually Leandro? How do you define yourself?
Yeah, so I'm 29 years old, even though some people tell me I look younger. I'm from Spain, and actually, I didn't start working in the world of investing. I studied economics and started working for a consulting firm. But I did start reading about investing when I was around 18 years old in university. I always tell this story, but the problem in Europe in general, I'd say, is that financial literacy is pretty low. So you don't get a lot of courses in university that talk to you about investing or the stock market. So that was a problem. But fortunately, I took one course that did talk about capital markets, and that led me to start reading more about investing, and that's how I started investing my money. I started investing in index funds, like I believe everyone should do, even if the goal is to end up investing in individual stocks. And then I worked in consulting. At the end, I saw an opportunity to do this full time, and now I do this full time, which is great because my learning curve has accelerated exponentially. Right before, I didn't have as much time to read about investing or to analyze companies, and now that's basically what I do every day. So it's been great.
Yeah, wow, that's I think that's really the dream of many people, but I guess as always people tend to idealize something. So I do know that private investing has a lot of advantages, but it's also a big challenge. You have to live off your own balance sheet and so on. So this wasn't a planned question, but I'm wondering what are the biggest advantages you found in private investing, and what are the biggest challenges you have to face on a day-to-day basis?
Well, I think private investors have a very significant advantage with respect to professional investors, right? When you see a lot of people tend to be worried when they see the stats that claim that 90% of active managers don't outperform the index over the long term. And don't get me wrong, I mean, outperforming the index over the long term is very tough, right? But private investors don't have to face the same incentive structure as the as as professional investors, right? If I'm a professional investor, I basically make money of my assets under management, right? Earning
Yeah.
two fees, the performance fees and the management fees. So the more assets under management I have, the more money I make. So the problem comes from how do you get more assets under management, right? How do you increase that metric? And in many cases, because you are catering to less sophisticated investors, the way to get more assets under management is to beat the market every year, right? Because if you appear in the list of top performing funds, then you're going to get money, and if you don't, you are not going to get money, which doesn't speak in any given year about your quality as an investor, right? So I think professional investors face a lot of opportunity cost choices, right? I mean, if a company stock is going down for a long period, then a lot of these managers would probably not want to have that stock in their portfolio, right? Because maybe that's going to penalize short-term returns, and then it's going to impact your assets under management. So I think a private investor doesn't need to worry as much about opportunity cost, so long as they believe that over the long term they'll make a good investment in a good return in that investment, right? So I think that's one of the main advantages, especially because professional investors also face another challenge, which is that when times get rough, right, and the market goes down, you're probably going to face quite a bit of redemptions because people are going to get scared. I mean, everyone says that they can withstand a 30% drop until it comes, and then they cannot withstand it. So then you're going to face redemption, especially when you would be wanted to add, while a private investor can perfectly be counter-cyclical. It's much tougher for a professional investor to be counter-cyclical. And in the challenges for private investors, as you said, probably if your only income stream is your investments, then I mean that's a challenge, right? Because you're going to have to draw down your portfolio every year to get your living expenses, or maybe build a portfolio of dividend paying companies so you can get a recurring income stream. But if you have other let's say other income streams besides your portfolio, then I think it's pretty much all advantages for the private investor versus the professional investors. Professional investors, many would say that they also have more access, a better access to information. For example, I would say that maybe that's not too helpful in the world we live in today. I mean, private investors can access plenty of information and probably more than is necessary to make an investment decision.
Yeah. Yeah, I think you framed it very well. And actually, um, I'm curious to dig in more into this topic because I think so many people are curious about private investing and how it works and the vaccines and so on. So I was wondering, what was the point, or when do you reach the point you said, okay, I'm ready for private investing, even if I guess you thought this way, I'm not sure, but if I have 1 or 2 bad years, I can still have a house or survive or something. So
Mhm.
yeah, how guide us through how you thought about making the leap between a 9 to 5 and private investing.
Well, actually, for me, it was quite easy, right? Because I was very lucky that my boss in the consulting company was great, and I'm very grateful to what he did. So I told him that I had an opportunity to do this full time, and that it was actually what I loved, but that I was also unsure that if I left and it didn't go well, what would I do? And he basically told me that I should do it, and if it didn't go well, he'll basically I just had to call him so he would hire me back. So it was I actually left with a safety net, right?
Okay,
So
yeah.
I think that that was very important to be able to do this. And if that person probably wouldn't have told me, look, if it doesn't work, you can come back, then I would have thought quite a bit about it.
Yeah, yeah, for sure. And there's some cognitive dissonance here because you have those like business gurus saying having a plan B makes you weak and like go all in and stuff. But I think for investing, it's a bit different. If you're investing with a pressure, like a hidden pressure of having to perform and stuff, you'll end up doing short term decisions unless you have like a really tough, let's say, mental structure and so on. So yeah, I think that was the ideal situation, and I wish everyone has that opportunity. But also, I should mention that I bet you were a pretty good employee, otherwise he wouldn't kind of give you that opportunity anyway. So yeah, congratulations for that.
Thank you. I think that's a question for him, but I imagine he was happy with me if he was willing to let me come back if it didn't work.
Yeah, exactly. So yeah, um, let's give roses to your former boss. um, now jumping more into your actual investing style, because I do know it's pretty unique and you're very disciplined in it. So I saw you mentioned it was pretty similar to Chris Mayer's approach, but you have a different kind of flavor to it. So why don't you explain to us what you look for in an investment and how you think in general about looking for these gems?
So I think the headline of what I look for in an investment probably is like everyone should look for is good at risk adjusted returns, right? I think a lot of
Mhm.
people tend to think a lot about returns, but don't tend to think too much about risk. And I mean, it's normal because risk is very difficult to measure, right? It's very easy to measure when it has already happened, but when it has not happened, it's quite tough to
Yeah,
measure. So I think that every investor should strive to maximize risk adjusted returns rather than returns. I mean, on a very simple example, let's say a 12% or 10% annual return in a relatively stable and safe company might be a better investment than, say, a 30% annual return on an early stage biotech, right? I mean,
yeah,
it worked that time, but it might not work the next. So the risk is much higher in the early stage biotech. I remember talking to Pulak Prasad, the writer
oh
of
yeah,
How What I Learned About Investing from Darwin, which is a great book that I highly recommend. And well, he basically said that if you don't think in terms of risk adjusted returns, you're probably going to over obsess with the CAGR, right? Which
yeah,
is what a lot of professional investors do. They simply over obsess over the CAGR because that's what you're going to be measured upon, and they don't think too
yeah,
much about risk, which is probably what's going to make you survive. So that's like the headline, right? So I look for quality companies that have, let's say, kind of a downside, the downside protected, and have a decent opportunity to achieve double-digit returns,
okay,
which I think is very acceptable if the risk is low. So I'd say that it's quality is a very broad term, right? So I define quality in terms of a company that is growing, that is profitable, has a very strong competitive advantage, a very strong financial position, which I think strong like diminishes risk by quite a bit more than people think. I mean, a lot of people tend to look for companies that are maximizing return on equity, but I tend to look for companies that are already profitable in terms of return on increment on invested capital and return on equity without needing to leverage the balance sheet, right? Because I think that the leverage in the balance sheet poses a risk to durability that you're not going to see when you look at the return on equity number of last year or with a
yeah,
1 year time frame. So that's basically what I look for in companies. It's probably easier to describe than to apply,
yeah, for
especially
sure.
because in this kind of when you're investing in this kind of companies, you need to be. I'd say it's very important to do your homework beforehand and be very patient because they don't tend to trade cheap. I mean, these companies many times there'll be, let's say, regarded by the market as being high quality. So then that will be reflected to a certain extent, maybe not fully in their multiple. But there will always come a time when these companies are going to fall out of favor, either because there's been a market drawdown, like was the case in 2022, or because there's something company specific that is creating that opportunity. And this is why I say that it's very important to do the homework beforehand, because if there's something temporary impacting this company, if you have not done the work beforehand, you're very likely to think that it's permanent rather than temporary, even if it's temporary, right? I mean, the companies that I have in my portfolio that I have researched already for more than 2 years, I I know when there's a problem, if that problem, or I know to a greater extent that I would if I wouldn't have followed them for 2 years, if that problem is temporary or if it's permanent. But at the same time, I put my glasses on of let's imagine that it's the first time that you're looking at at this company, and I read that problem, and I would probably think that it's permanent, right? Seeing how the
Right.
market reacts. So I think that's
Yeah.
very, very important.
Yeah. That's certainly a way to create alpha, I would say, because not a lot of people look at companies in that way, and from my experience, even in this short time I've been investing, I've seen really, really high quality companies consistently getting beaten up by the market because of short-term problems, strikes, or whatever it is that is happening. And yeah, it's really interesting how you don't really have to act that fast. You actually have usually you can have big gaps where you can invest at reasonable prices, and if the gap closes too fast, then it's okay, you just have to move on to another one. So yeah, that's really a wonderful approach, and it's
And I
fascinating.
think another very important topic here is that a lot of people will tell you that high quality companies, even if they are mid caps or large caps, regardless of the size, they'll tell you that they are followed by the market,
Yeah,
by a lot of analysts. So you will not have an edge. I think it has been proven that this is not the case, right? There are inefficiencies in the market in large cap, mega cap. I mean, Facebook is a clear
yeah,
example. Amazon is another example. Nvidia is another example. I think there are lots of inefficiencies regardless of market size. People tend to think that data has made the market more efficient, but I honestly would think that it has happened, like the contrary has happened,
yeah,
right? I mean, when you get constant information flows from a given company, then there's a lot to interpret, and there's going to be a very low signal to noise ratio, right? So
yeah,
if
yeah,
you know the company well and focus on what's important, it's likely you'll find opportunities just because the market is overreacting to some news. For me, I think honestly, I have several companies in the portfolio where when I go to look at the news of those companies every week, there's basically not been a single article written about them for 3 months. And I think
yeah,
that's the best company to have in a portfolio, right?
yeah,
Because you have a high quality company that you don't have to worry about all the noise and filtering the noise to see what's signal, what's noise. I think it's much tougher to invest in a company, which I also have those kinds of companies, where you get news every single day, right? About something that's worrying or something that's going to be the next opportunity. I think that's much tougher to hold than something that's probably out of the spotlight. That's evidently true, but I don't think that more information leads to more efficiency. I mean, I don't think there's any proof that that has been the case.
yeah. And I would imagine that you have more B2B businesses, because yeah, those tend to have less news coming out because no one knows them. And news actually just want to get eyeballs, so that's something interesting. And you were mentioning risk adjusted returns, and I find this a really interesting concept, but it's hard to apply in practice. And I saw that you focus a lot on lowering volatility, and I was wondering whether this is more of a personal trait that you have, that you feel like you're a better investor when there's less volatility, or you associate that with long-term risk.
Well, I think it's what I've just discussed is basically the same, right? Lower volatility makes a portfolio easier to hold over the long term. I
Mm,
don't think volatility is risk. I think it's opportunity.
okay.
But at the same time, it's much tougher to hold a company long term that is going down 40%, then shooting up 100%, then going down 30%. I mean, that's much tougher to hold, even if over the long term it's going to go up, right? So it's secular in nature. I think I don't have as much trouble with volatility, but I know that subscribers to best anchor stocks, some might have more trouble with volatility. And I think you can find also very good companies that are not very volatile. In fact, I would say that volatility also plays an important role in a company's operations, right? I mean, it's much easier for for the CEO of a public company to be focused on the long term when the stock is not super volatile, that maybe it goes down and he can get fired by shareholders, right? And in general, it's easy to create value when things are more stable than when things are more volatile, unless you are super counter cyclical, right? And you create value that way. But I think it's easier running a business that's more stable than a business that is more volatile. In fact, many of the companies that I hold in my portfolio, more than hyper growers, are they are steady growers, right? They grow,
Mhm.
let's say, high single digit, low double digit every year, and it's pretty consistent. I think it's very easy. It's much easier for a CEO to do that job than to do the job of a company that is growing 30% one year, then it's going 10% the other year, then growth decelerates. You have to face a declining stock price, and maybe a lot of your employees have money in the company and they also have to face the declining
Yeah.
stock price. So I think that's one of the reasons. But I must say that I've come to appreciate this, let's say, quasi cyclical companies that are secular over the long term, right? I think, for example, the semiconductor industry is a very good example of this, that they tend to go through cycles. This tends to happen in industries where there's a lot of capex involved, right? Because capex tends to be pretty cyclical, whereas opex, operational expenses, tend to be much more stable. So if you are selling to, if your, let's say, if your product is on the capex of your customer, then there's a high likelihood that you're going to be more cyclical than if your product is in the opex. And I think those industries are very, let's say, interesting, because you tend to get companies at a very decent prices from time to time, basically because of what we've mentioned at the beginning of the podcast, because people don't want to hold a business that is going into a capex cycle, right, or a down cycle, let's say. I think there are
Yeah.
lots of opportunities in those kinds of industries. Like I said, semiconductors is the clear one, right? You have capex cycles when they are building capacity, then they feel they have overshot capacity, they stop ordering, then the companies get cheap, and when they get cheap, they look expensive because their earnings are not normalized. So not only the people who hold them want to sell them because they don't want to face the declining price, but people who might be interested in them probably look at the valuation multiple and will say, "Oh, this is very expensive. I don't want to own it." So I think those are very interesting. But yeah, I think volatility is not at risk. It's not a risk per se, but it leads to one of the main risks in long-term investing, right, which is selling beforehand.
Yeah, and you were talking about semiconductors, and I was just recalling an interview you did with these two Spanish guys, and you were breaking down all the businesses that you owned at that point. And I really love the semiconductor part, the analogic semiconductors, and so on. So for the Spanish crowd, I'll link that interview down below because I think it's really interesting. For the other ones, I'm sorry, but the interview is in Spanish. So yeah, but. Moving on to the next question, you were talking about best anchor stocks, and I mentioned I really love this Substack. And why don't you explain to my audience what it is, what is you're trying to do, and how it works in terms of subscription model and so on.
Yeah, so basically, Best Anchor Stocks is my, let's say, investing blog, right? It's an investment research service more than an investing blog, although I also write about investment related topics, so not all the time company specific articles. So, what I have done with Best Anchor Stocks is basically, let's say, build my portfolio of what I consider to be high quality companies. Of course, quality in many cases, I don't think is that subjective, but many people would say is subjective.
Yeah,
Um, and what I do is share the research uh, from the companies in my portfolio, and also from companies that I might be looking at, but I don't feel that they are interesting at the current levels. And that's basically what I do. And well, the subscription model is basically that you pay an annual fee, and then you get access to everything, to my portfolio also. And yesterday I even, well, it's not going to be yesterday when this is uploaded, but yesterday,
yeah.
from when this is recorded, I uploaded a new feature that basically I called it the decision spreadsheet, that has all
Oh
the
yeah,
companies in my portfolio with all the prices that I would be willing to buy at, right? And with all the details of the valuation of those businesses, which I think that subscribers really enjoyed seeing that feature, right? Because I imagine you go right now into the service and you see a company, you read the research, you like the research, but basically the valuation is going to be outdated, right? So you don't know
yeah.
if that's what I feel is a good buy today. Well, now with the decision spreadsheet, you can see it. I would also say that it's not. a recommendation service, right? I run my
Mm.
portfolio, I share the research, but everyone is responsible for making their own decisions. Why I share the research is precisely to achieve that. So people can read the research and maybe be convinced about one company or not convinced about a company. I mean, I have subscribers that have, let's say, 80% of the companies that I have in my portfolio in their portfolio. I have subscribers that have two companies that I have in my portfolio in their portfolio. So it's kind of that's the dynamic of the service.
Yeah, it's kind of not outsourcing research. It's more about really getting more details on a business you want to look at and maybe get a head start. So I really like that, and I really love the feature. I didn't saw it before. The feature you do like the valuations on an updated basis, because that kind of also helps your subscribers and yourself to know what's the benchmark for opportunity cost. So if there's this business selling at X and you are willing to buy it at X minus whatever, uh, then you can calculate the IRR or the CAGR, whatever, and then you have like a comparison and see, okay, do I want to buy this other business that I don't know as well when I can buy this other one and have the same return and so on. So yeah, that's really interesting, and I think that's really
Yeah. So
original.
the goal is basically to automate the process, right? I mean, well, I believe that once you have studied a company in detail and you have it in your portfolio, the rest of the work on that company is going to be monitoring,
Yeah,
probably reading more information about the company as it comes out, and then being very aware of what that company is worth to you, so that when the market gives you an opportunity, you are going to be ready to pounce on it, right? I honestly, there are three decisions you can make with any position,
yeah,
right? You can add to the position, you can hold it, or you can sell it. In my new feature, there's only buy or hold, right? Because I very rarely sell for valuation reasons, because I think there are three impediments to do so, right? One is
yeah,
taxes, obviously. Every time you sell, then you have less dollars to reinvest. The second one is reinvestment opportunities. So if I sell, I need to find another opportunity which is better. That might be the case, or that might not be the case. And the third one is optionality, right? I mean, if you
yeah.
invest in high quality companies, they're probably going to come up with something that you didn't expect. So
Hmm.
if you sell based on a, let's say, relatively expensive valuation, you may be missing up on those. And then the fourth one, which is very personal, is that I tend to have a lot of trouble, let's say, going out of a position and rebuilding it. I mean,
Mm.
for me, that's something that's purely psychological and something that I should improve. But it's something that it happens to me, right? So that's
Yeah,
why I very rarely sell due to valuation reasons. I acknowledge valuation, so I will not add to those positions that I feel that are expensive, and will wait for better opportunities, and I will keep adding to those positions that I feel are the best value right now.
yeah, and then when you you try to kind of time your sells and buys and rebuy at another time, then you never end up buying and you just miss out. So yeah, I think that's a pretty sensible approach. And I was wondering if there is kind of this money management effect on running a paid Substack, because obviously money managers have the pressure of having clients and they have to deal with redemptions and so on. In your case, you're not running other people's money, so I guess it's easier, but you also kind of have an obligation to put stuff out there. And I do know you're a very high quality individual, so you won't just put out anything that comes along the way. But um, how how has running a paid Substack hurt or benefited your returns in your actual investing?
Yeah, so I think writing has benefited my investment process a lot,
Hmm.
especially because, I mean, it's not the same to read something and then to read and write about it, because when you
Yeah,
write about it, then you start to think more profoundly about what you've read, and the questions you start, let's say, questions start popping up in your head, and then you have to answer those questions. So I think it's much easier to go to what really matters when you're writing. So I think writing 100% has improved my investment process. As you said, probably the main challenge you have is not about recurring, like the recurring nature of the articles. I mean, I write very recurringly, right? I think I write two or three articles per week. But I don't think my subscribers care as much about how often I publish articles, more about the quality and also about new
Yeah,
information. And that's the challenge, right? I mean, um, I don't add companies to my portfolio every month, right? I mean,
yeah,
and maybe there are people that are expecting that I'm going to release a good investment opportunity or an actionable investment opportunity every month, and that's not going to happen, right? So that's why I have started writing about companies that I am not going to buy, so I'm not going to add to my portfolio, but that I think are interesting. So people get also new information about interesting companies, which you do also learn a lot. I mean, a
yeah,
company might be great. I mean, very high quality, and the only thing that's missing is the price, right? So it's worth it to release the research for people to read it, and then you just wait and see if it gets into a buying range. It might never get to a buying range, and that's the tough thing about investing, right? I mean, I've seen several investors that their portfolio is, let's say, comprised of the only companies that they have researched in during their investment career, and I think that's very dangerous, right? Because
yeah,
investing is mostly a game of saying no. I have right now 15 companies in my portfolio, and I've probably researched since starting best anchor stocks more than 50.
yeah,
Obviously, the depth of the research is not the same in the 50, because in some companies you basically read the annual report and you more or less know if you want to discard it or if you want to dig
yeah,
deeper. In other companies, you get to the end and then what's missing is the price, right? Because I always leave valuation for last, because I don't think I can
yeah,
judge valuation when I know little about the company. So yeah. I mean, it's a challenge that you have to release new content, maybe new companies. But I think on the on the overall, I think it's more positive than negative to share
mm,
your thoughts. Obviously, because when you write, you self-reflect, but also when you publish it to the public, then someone can come with an opposing view and maybe have a different viewpoint. So I think that's also very useful.
yeah, yeah, for sure. Yeah, that's really good. And when you said like I researched 50, I was thinking, wow, if you researched 50, you must have looked at, I don't know, hundreds of them, because yeah, you have those companies that you discard right away because you see something that you don't like and you don't even research them. So yeah, congratulations on that. That's a pretty good rate. And like you were talking before about coming in and out of on a position, and that you don't really like to do that, or you're not suited for that. I was wondering, how do you go about building a position? So let's say you've researched a company, you're pretty confident this is a very good investment to add to my portfolio. You already have the cash on hand. How do you build that position? Do you go incrementally, or yeah, how do you think about it?
I typically go incrementally, especially because lately I have been investing and analyzing, some of which I'm still analyzing companies that are of the kind of what I discussed before, right? I mean, companies that are going to, let's say, you're a very capex intensive cycle, or their market is in a downturn, maybe because that's how the market works, right? It's a bit cyclical, or maybe, and we are seeing this after the pandemic. There's some destocking and stocking issues that are, maybe their customers are destocking, so they are not getting as many sales. So I tend to look at those companies. So then I think it makes sense to build a position incrementally, right? Because while I understand that the company is cheap today, I don't know what it will do, if I might get cheaper in over the long term. I tend to start, let's say, with one quarter of a full position, and then I build it up from that point on. That's worked for me over time, but that's also penalized my return in some cases, right? I mean, I there are companies that I started building my position slowly, and then they run up on me, and then it was very tough. And now they weigh, let's say, less than they should on of my portfolio. But that's I mean, that's a risk I'm willing to take, right? Because there's also been other cases where I've started building my position slowly, and then the market has gone more irrational, and then I've been able to build it cheaper even, and then those have
Mhm.
worked great too. So I think it's a case of, let's say, of personal choice. I mean, the logical choice if is that if you think something is cheap, you should basically build a significant position from the start, right? And then obviously, as you learn more about the company, maybe you get more confident, you can overweight that position. But this is what I've done since the beginning, and what works for me. And I don't I mean, I'm not afraid of changing it, right? If I
Yeah,
see a
yeah.
company that's a very good opportunity, I might build my position faster than I have in the past.
Yeah, that's pretty cool. And Leandro, correct me if I'm wrong, but I think you hold between like 13 to 15 positions. So yeah, do you feel like that's your sweet spot, or do you want to lower that number or increase that over time?
Yeah, so my sweet spot is somewhere between 10 and 20.
Okay.
Right now I'm at 15. It's not that 15. I don't want to take the midpoint always. I think it depends on opportunities where you fall in
Yeah.
that number, right? Or the, like we said before, the actionable investment ideas.
Yeah.
Sometimes it might go higher, sometimes it might go lower. The maximum I've had is 16, but I sold one company, and 20 is the maximum I would ever go to, because I mean, I struggle with 15, following closely 15 companies. So I don't think that I going over 20 is going to be, let's say, value added for my portfolio. And when you go over 20, you also start to have positions that are maybe pretty small, right? Let's say
Yeah. Yeah. Yeah.
2%, 1%. And I don't think it's worth it to do as much work on such positions as on positions that are larger. But and then less than 10, probably that's too concentrated for me. I mean, I invest in high quality companies. I believe they have a great future ahead, but we're going to make mistakes, right? I mean,
Yeah.
that's probably the toughest part of investing, and that if you come here thinking that you're not going to make mistakes, then you're going to get humbled.
Yeah.
And probably also the toughest part is that you can, or the, let's say, that's the toughest part, and also the greatest part, right? Because you don't need, due to how investing works, where you can, to the upside you're not capped, like your return is
Yeah.
not capped, but to the downside your return is capped at 100%. You don't need to be, let's say, you don't need to have a very high probability of success in your portfolio to do well over the long term. And I think that's a great advantage, and the main reason why I don't understand shorting, right? Because when you short a
Yeah.
stock, you're basically flipping that relationship on the other side, where your gain is capped at 100% and your loss is infinite. Obviously, when people short, they typically hedge and they put stop losses and whatever. So the potential loss is not infinite. But I mean, you get me.
Yeah. Yeah.
The
Yeah. I do.
best thing about investing is that you have an uncapped upside, and then you have relatively capped downside. So why turn that around? I mean, I've always thought, to be honest, that shorting in some cases is a bit of an activity of ego, right? I mean, there are
Hmm.
hundreds of companies where you can invest and make money to the upside. So why focus on those bad companies that you
Hmm.
can that you think are terrible, and you want to make money while they go down? I think it satisfies an important, let's say, market function, right? Because prices get adjusted quite fast for the terrible companies. But then you see that there's a bit of ego when people start talking, for example, about shorting Berkshire Hathaway. I
Yeah.
mean,
Yeah.
there are hundreds of terrible companies that are probably not priced as such. When you are trying to short Berkshire, for me, that's an exercise of pure ego, because you want to be right shorting
Yeah.
one of the best companies in the world.
Yeah, exactly. And then you also have to have a much more acute time framing, because let's say you're right on your thesis about shorting this business, but it goes up, I don't know, another 100% or whatever, then yeah, you just lost a lot of money, and then margin calls and stuff. So
Mhm.
yeah, I would say it's more similar to gambling, and we have to leave it to the people that like to do it.
Mhm.
So yeah, I agree with you on that one. And actually, we've discussed investing enough to understand that investing comes along with a lot of emotions. It's not just about making objective and rational decisions. It's also about managing your own emotions. So I was wondering, what systems or strategies do you use on a day-to-day basis to kind of, yeah, manage your emotions and make sure that you're not making an emotional investment decision?
Well, I think emotions in most cases are you get them from birth, right? I mean, people react different to volatility, and that's just because they are like they were born that way, or they weren't born that way. Now that said, I don't think that if you have trouble dealing with volatility, you simply should stay out of the market, right? I mean, there are
Yeah,
methods to lower your exposure to volatility. I mean, if you are impacted by volatility, then maybe a coffee can approach, or investing an index is more appropriate with your style. But even an index, we've seen that can be very volatile, right?
yeah,
So I think one of the ways to deal with volatility is not opening your broker every day, which a lot of people do, right? They open
yeah,
their broker every day and look at the investments. I honestly don't care. And I mean, we were talking before starting the podcast that in Europe, especially when you talk about investing, people will tell you, yeah, I mean, I trade, or I mean crypto or something like that, right? When you talk about in investing, because that's how they view investing. And those are the kind of people that look every day to the investments. They every week they tell you how have you done. So I think that's not, if you're surrounded by those kinds of people, then it's going to be very tough, right, to invest for the long term. But
yeah,
I mean, I don't have trouble with volatility. I try to minimize it, but I don't have trouble with it because I don't look. First, because I don't think that, based on who I am, I'm going to have trouble with volatility. And secondly, because I don't look at my portfolio every day. So I do look at it every week because I have to update the performance. I only show performance since the inception. Now that
okay,
we are seeing everyone show year to date returns, I only show the performance since inception because I think it's the only one that matters, right?
hmm,
I mean, it doesn't matter what you've done this year if last year you were destroyed. So I think that's also an important consideration, and also what might make professional investors be short term, right? They show
yeah,
3 month performance, they show year to date performance, 1 year performance. I mean, I think in most cases those data points are irrelevant if you have a track record of more than 1 year.
yeah, yeah. And the whole point of, I don't know, tracking performance is to kind of get a feedback on how well you're doing over time. It's not like, yeah, when you track like a quarterly performance is basically a snapshot of, yeah, the output you got from your decisions, but it's not really signal, as you were talking before.
Mhm.
So yeah, I think that's a really innovative approach, and I really like it. And then if people want to calculate the Kager, they can do it. So it's also not hiding any information from anyone. So yeah, I think more people should subscribe to that approach. Yeah, so then there's also this kind of emotional thing that I want to go deeper into, which is humility and ego. We were talking about shorting and how it's an exercise of ego and so on. So yeah, how do you make sure you don't get too high on your own supply when things are going well and everything seems to yeah, to be a good decision and so on? So during times of markets and stuff, how do you think about keeping your humility in check?
Well, I think that the easy answer here is that the market works so well that if you don't keep your humility in touch, the market will humble you in due time. So you'll have to keep it in touch, right? That's one of the toughest thing about the market too, right? When you think you are on the top of the wave, then the market will probably come and show you that you are not in control, at least over the short term. I
Yeah,
think the feature that I discussed before about the decision spreadsheet, I think it's a good way to keep your humility in touch, right? Because you have your valuations, you know what a company is worth, you know if your portfolio companies are over or under that, so you know if actually the increase is that you've done a good job, or if the market is getting maybe too optimistic, right? I think that's a good first point, but again, I think this comes back to how you're born, right? I mean, there
yeah,
are people that have a more, let's say, they have they will probably tend more to being to ego than to humility, but that's
mm,
something that you are born with or not. Maybe we are surprised to see a lot of the best investors in the world being pretty humble, but
yeah,
that I think is a case of selection bias, right? Because
yeah,
to
yeah, yeah.
get to the being one of the best investors in the world, you have to be humble. It's not that they are that only if you're humble you can invest. It's just that maybe only humble people get outstanding long-term performances, right? So that's why you
Mm,
hear about them. So I think that's important. But I mean, what's surprising to me is that there are lots of people which make forecasts. They basically don't. They get wrong all the forecast, and they
yeah,
still have ego. I mean, for me, that's incredible, right? And the case, I think that has happened because those people make quite a bit of money from the media,
yeah,
even if they're not right, right? So there's no market to humble them because they are going to keep making money even if they're wrong. Now, if those people made forecast and put all their money behind that forecast, I think they would, like, their ego would drop down quite fast.
yeah. They just break the feedback loop, so they get, let's say, rewarded for saying dumb stuff. I don't want to mention names, but all those people on TV that make, yeah, all the forecasts. And if you read Super Forecasters, then you really get a sense of how wrong people can be on average. So yeah, that's a pretty interesting way to look at it, to say so. And before we jump right into softer questions, I want to go back into best anchor stocks. This is just a tangent here, because as we were talking before recording, I really have been thinking about ways to add more value to my guests, because at the end of the day, yeah, I don't have a lot to offer. So I was wondering, how do you manage to get such good guests to Best Anchor Stocks? And if people don't know it, Best Anchor Stocks also has a podcast. Chris Mayer was a guest, Francois Rochon, and many more. So yeah, how do you think about adding value to those people?
Well, I think that this is again an exercise of humility, right? When I
Yeah.
have Chris or Christian, Tree, Francois Rochon in the podcast, I don't think my goal there is to add value to them,
Mhm.
but rather to create an environment where they can teach me and the listeners what they know, right? So I mean, I consider that I'm self-sufficient as an investor, right? I mean, I
Right.
manage my own money, but at the same time, I know that there are other great investors, and there's a lot to learn from them. So I think it's more about creating a good interview so that they can add value to the listener more than me having to add value to them.
Oh, got it.
Which in some cases you might add value to them, but I don't think that has to be the end objective.
Mm. Yeah, I think that's a different way to look at it. I hadn't thought about it, so yeah, thank you for that one. And a question I'm always really curious to know about all the people I talk about is, how they allocate their time, because we all talk about capital allocation, but allocating time is it's tougher or as tough as capital allocation. So how does a typical day look like for you since you are investing on your own?
Yeah, so typically I will wake up and I mean, in if I look at it, the headline would be that 80% of my time is spent reading and 20%
Mm,
is spent writing.
mhm.
That was definitely not the case some years ago. Probably you had more percentage of the time being allocated to writing, but I think I've gotten better. So now I spend less time writing to achieve the same quality. I mean, there's been efficiencies there. But most of my day is reading. It might be reading about companies that I hold in the portfolio, about new companies, also about investment related topics, general topics. And when I wake up, I tend to leave the things that 100% I need to do, like writing, uh, for the afternoon. I think that helps me because if the problem I have is that if I do all the things that I need to do early on in the morning, then it's much tougher for me to concentrate on the rest of the tasks that might not be as, let's say, compulsory, right? I mean, I can read or I cannot read about a company. So that's why in the morning also I've rest if I've rested well, then in the morning I've been my brain would be at 100% to read about new companies, which I think I absorb the information better. So yeah, I basically read all the morning, a bit of the afternoon, and then I write, and then I release the articles, or I do things related to the service too, right? Because at the end of the day, this is also a business. That's one of the
Mhm.
things that people don't understand, right? When I talk when I talk to people here in Spain that mainly trade, for example,
Yeah.
and they tell me like, you invest, so what do you do during your day? And I'm like, yeah, 80% of my work is like reading, right? And they're like, well, I don't understand. I don't Basically 80% of my day is trading. And I'm like, yeah, well, that's different ways of investing. I don't spend time opening my broker and seeing what I can buy or what I can sell. So yeah, that's my day. It honestly seems a bit boring to say 80% reading, 20% writing, but I honestly love it. And I think it's fascinating.
Nice, nice. Yeah, I like that too. And I guess we are kind of a different breed. Not all people would think this is a fun thing to do, but yeah, as long as we like it, we are fine.
Yeah, I mean,
So
not a lot of people would spend 80% of their time reading about any
yeah,
topic. Well, imagine spending 80% of your time reading the footnotes of an annual report. I mean,
hmm,
less people even would do that.
yeah, yeah, for sure. Um, that's really true. I don't know if you have time to do a couple more questions, but I
Yeah,
have
sure
some
thing.
company specific ones. So
Yeah, go ahead.
yeah, nice. So the first one is related to Topicus, because I'm be prepared because this will be a bit devil's advocate. But the first one is related to Topicus, and when I think about Constellation, it's a really wonderful business and it has a bulletproof track record. But my main concern is about how they retain their M&A staff, so their employees, because I do know there's a lot of churn in that category, and a lot of them are going to private equity, and a lot of them are building their own copycats. So yeah, how do you think about that going forward?
Well, I think it's always been a problem, right, for Constellation also, mainly because if you do well on Constellation, then you're going to get, especially if the stock does well, also you're going to be like your compensation is going to be very good. But it's no
Mhm.
secret that Constellation is not the company or Topicus that pays the most to its M&A employees. I think that as time goes by, it matters less, right? I think there's also a lot of churn in M&A in general, not only in Constellation,
Mhm.
but I think it's a very tough sector to be in. But I say it matters less as time goes by, because Constellation right now has, let's say, a database with more than 1,000 acquisitions of what worked and what didn't work. So that obviously is what they use to guide the decisions of M&A going forward, right? So it's less dependent on a given individual. Even it's not even as dependent on Mark Leonard and as people think it is,
Yeah.
because it's all about delegating and using the data that they have from previous acquisitions to make future acquisitions. So I think it's obviously not great to see that, but at the same time, I think it's less important than people think it is. I think it would be much more worrying, say, to see a high churn of employees in the organic initiatives than in the
Yeah.
inorganic ones, especially talking about Constellation and Topicus, which have been more in Constellation's case, right? Because they have been historically a serial acquirer and they have a lot of information about potential acquisitions. What I mean is that even if you get someone that's relatively new to M&A, they will probably have the tools to work their way through, right, and to
Hmm.
replace someone that's maybe more experienced. And if you're one of the big guys, one of the presidents of the operating groups or Mark Leonard, obviously you're very, very well compensated due to your
Yeah.
stock ownership, right? So you don't have a reason to leave.
Yeah. Yeah. And also, this was uh, a no question after all, because I think the data is a bit misleading, because I think most of the churn is on the lower end of the, I would say, pyramid, so to speak, whereas the kind of the people that really drive the culture, they stay, and they tend to stay for a long time. So yeah, I just
I
wanted to
mean,
pick.
we don't have data on, for example, well, you can collect it, but you don't have data on the middle managers, right,
Yeah,
and
yeah,
how they are retained. But you do see the top guys, right, the president
yeah.
of the operating groups, and they have been working for Constellation for more than 20 years, right? So I mean, it's not like there's churn in that part, which would be probably a bit worrying.
Yeah, yeah, for sure. Um, yeah, it's interesting business. I just wanted to pick your brain. And the other one I'm curious about, which I know you follow pretty closely, is Hermes. Um, and I've been, I'm kind of sick of listening like how good this business is, but I've never had the curiosity to actually go through it, because I don't think it's much on my circle of competence and assessing, well, how people will like this brand over time. And yeah, so why don't you guide us through why you think this is a super high quality business and worth holding in your portfolio?
Yeah, so I think that when many people think about luxury, right, they think about growth in terms of price. I mean, I can raise prices a lot, and my consumer is not going to be, let's say, the demand curve is inelastic, right? I mean, you can
Mhm.
you can raise prices, and you're practically going to get the same demand, or even better, right? Because it's a Veblen good, so maybe you raise prices and you get more quantity demanded. That's how exclusivity works. But when you look at Hermes, and in the past, Hermes, I think over the last 2 decades has grown revenues. I think it's 12% at a 12% CAGR. And you look at what has been the driver of that revenue, it has not been price.
Yeah,
It has been mainly volume. So when you think about that, I think it's pretty powerful, right? So you have a company that's grown 12% per year, which in which price is probably the main lever. They have a lot of pricing power, and they have not used that pricing power, right? So that pricing power is still there to be used, and I think that's what makes it such a great company, right? You have a latent pricing power that they are saving because they know, and this is the first time that I've seen it in a public company, but the CFO of Hermes has openly talked about the terminal rate,
okay.
which I have not seen any CEO do of any other public company. And he claimed that he knows that their valuation multiple is tied to their terminal rate, and then they will do everything that it takes to not sacrifice that terminal rate. How many companies have you seen talking about durability in that way? I have not seen any company do it, and it's normal, right? Because you have 70% family ownership here, so families are thinking about the next generation. And in other cases, when you have a CEO or a CFO that are there for 5 years, what's their incentive to think about the terminal rate, right? They're
Yeah,
going to think about the next 5 years at maximum. And because that's the amount of time that they are going to run the company. So I think that makes it pretty special. So I always define Hermes as a company that I believe is in control of its destiny. And when that destiny is very aligned between the operators, because they are the owners, and the shareholders, then I think that's a pretty powerful combination, and worth quite a bit of money, right? So I think that there are very few companies that you can claim, oh look, this company is practically in control of their future. I mean, if Hermes next, let's say next year, wants to grow 30%, they probably can achieve it.
Hmm.
Probably they would sacrifice quite a bit of exclusivity, which is why they don't do it, but they could do it if they want, right? How many companies can grow, let's say 30% for the next 3 or 5 years if they wanted to? There are not many that can
Yeah.
do that without without impairing their business in the fourth or fifth year. So I think that's what makes it a great company. As for an investment, I would say that it got interesting some weeks ago, but then after the China stimulus, that ran up quite fast, right? So I personally don't think here is the best risk adjusted return to invest in Hermes, but I think it got pretty close some weeks ago. And what's interesting is that when China announced its stimulus, all of the luxury companies went up. I say quote unquote luxury because you've got all the aspirational companies going up, like Hermes and the other true luxury companies. And I think it actually doesn't impact Hermes as much as people think, right? I mean,
Hmm.
Hermes was doing, while all the aspirational luxury companies were getting destroyed in China, Hermes was doing fine. So I think it's more important. The stimulus is more important for the aspirational luxury companies than for Hermes. But well, if people want to put them in the same bucket, that's great.
Hmm.
And that's also the reason why Hermes from time to time gets attractive, right? Because people put it in the same basket as the aspirational luxury companies. And when the Chinese economy is not doing well, they think that it's going to impact Hermes the same way it's going to impact an aspirational luxury company, which time and time again has been demonstrated that is not the case.
Yeah, yeah, yeah. I think now you've convinced me to take a deeper look, because it's actually pretty unique that the CFO understands how compounding works and how important the last few years are for investment returns. And yeah,
Yeah.
well,
So
maybe.
if I should summarize, let's say what I like about Hermes, I think it would be very easy. It's a management team that's aligned with shareholders. They own 70% of the company. A management team that understands how long-term value is created, and a management and what the company is worth, and a management team that is in control of its destiny. I think that
Mhm,
finding those three things in a company is very, very, very tough. So
mhm,
I think obviously it's going to be worth more than other companies, which doesn't necessarily means that it's more expensive than other companies, which is
mhm,
what many people think is the case, right? I mean, I would much rather pay 40 times earnings for Hermes than 3 times earnings for a commodity business that is cyclical. And that's the way I view investing, right? I view investing from the point of view of durability, because when you are going above, let's say, a 15 times or even a 10 times earnings ratio, you need to be more worried about durability than about the next 5 years. But people
yeah.
focus on the next 5 years, which I don't really understand. But if you want, I also have a deep dive on Hermes. I actually uploaded it not long ago.
Yeah, that's I haven't read it. I think it's probably for subscribers, or is it
There's
for
a
it's
part that's for free, but yeah,
okay.
primarily for subscribers.
Okay, okay. Yeah, so I'll share that in the description, so anyone can see the free part, and if they're interested, then I highly recommend you subscribe to Best Anchor Stocks. So yeah. Leandro, I have a challenge for you. Since we are already in the end of our wonderful conversation, I will ask you really tough questions, but you have to answer in a sentence or in a really concise way, just
Okay.
to so we get like the first thing that comes to mind. So the first one is, what do you believe that other people think is insane?
That individual investors actually can have an edge over professional investors.
Mm, that's a good one. That's a good one. How do you value a business?
I use an inverse discounted cash flow model to understand what the market is baking in, and based on that and all the work I've done, I decide if I feel it's optimistic or pessimistic.
Cool, nice. And last one, what are you afraid of?
Oof. This is actually a tough one.
Yeah, sorry.
Um, I mean, if it's work related, not being able to do what I'm currently doing, say in 10 years, because I love it, and if it's personal, maybe something that could happen to any of my family.
Nice. I have a bonus one. Where do you want to be in 5 years' time?
Probably doing the same, and with good returns to show.
Nice, nice. Yeah, I think you did pretty well. I think we had a great conversation. I don't want to steal much more of your time. I think you were pretty generous already with me. So yeah, thank you so much. And whenever you want, come back, please.
No, thank you very much for inviting me. I think it was great, and the questions were also great. I mean, that's that says a lot about you that at your age you're able to do these questions. I've always believed that the person that is more important to make good questions than to look for answers, right? Because the good questions will lead you on the right path more than the answers which will probably lead you to a roadblock.
Yeah, yeah, that's a great quote to end with. So thank you so much, and see you next time.